Hello friends, finally I'm uploading this video on what the fallout of Donald Trump's election will be on us Indian investors and traders. More of traders because I am a trader. Now, why did I wait for more than a week before uploading this video? You see, the French historians have a theory that nothing should basically be covered by historians unless it is at least 200 years old. Why? Because enough weight of evidence, enough opinions, enough facts, and enough groundwork must be done before covering something and putting it forth to the public. But this is the internet age where you can actually retrieve old records, old antecedents, and old historical facts at the click of a mouse, and therefore you need not really wait 200 years, but definitely you should wait long enough to get clarity emerge. And clarity has now come in, so I now talk about whether Trump 2.0 will be the same as Trump 1.0. Now, what happened in Trump 1.0? There were expectations of a Trump reflationary rally. What is reflation? Reflation is taking a bicycle pump or a football pump and inflating or reflating the football. Now, Trump said, when I come to power in 2016, he said the stock markets will go up, commodity prices will go up, the US dollar will become strong, there'll be more jobs. In short, make America great again was his slogan, and it still is in this day and age as well. So, will Trump 2.0 will be an exact carbon copy or a replica of Trump 1.0? Let's take a look, because now we have the look back bias and therefore the capability to see what really happened. Trump is going to make America great again, or so his election manifesto states. Now, in the double entry system of account keeping, debits must match the credits. Otherwise, your trial balance and your balance sheet will never match. So if Trump wants to put America at an advantageous position vis-a-vis its trade partners, as per the double entry system of account keeping, if America as a trade partner wants to be at an advantageous position, America's trading partner, on the other hand, must basically compromise more so that America can have an upper hand. Which means that what we were expecting, or a lot of people were expecting prior to the election, that if Trump was to come back again, India would have an unusually outsized advantage, and therefore our markets would basically receive a magic wand and all ills would go away and markets would suddenly boom. Now, I waited for a week, and as you have been following me on Telegram and off late on my WhatsApp channels, my contact coordinates come at the fag end of this video in the description and the pinned comment below. So please connect with me there. I've been telling you that procyclicality is likely come what may, and why, and asset-wise. Commodities, currencies, bonds, and equities. We'll cover it all. So, if debits are equal to credits, if America is going to have an advantage, America's trade partners will have a small disadvantage. And small is an understatement. So, what Trump wants is, if you want to sell to the United States as an exporter, you must be willing to buy from the United States and import United States goods and services as well. Don't forget, the US is now a net exporter of oil, and it's been a net exporter of natural gas. So Trump will want us to buy oil and gas from America, and the payment obviously will be settled in US dollar, and Trump will not accept anything other than the US dollar. What happens then? Our Forex reserves will come down a little, or maybe not rise as fast as they have risen in the last 3 or 4 years after Trump lost the elections in 2020. The other thing is, Trump has been very, very clear right from the word go that he will impose tariffs on China. How does that impact India? Some people unknowingly and because of a lack of knowledge are celebrating. They think disadvantage China is immediately advantage India. If tariffs are imposed on China, which means Indian goods will go into America. It's not all that easy. If you're a business owner, you know that there is always a currency escalation clause in every import and export contract. Now, if China is levied with extra tariffs on their exports to the US, the Chinese have a way out. They will devalue their currency, the renminbi, and therefore make their exports competitive all over again. Unfortunately, that will mean other countries in Asia will have to match the Chinese devaluation of the yuan and devalue our local currency, which is the Indian rupee, so as to compete with China. Now you could say, hey, Vijay, so what? These guys devalued, we devalued, and since September 2012, we are in a state of currency wars as it is officially. So what's the difference? The difference is, my dear viewer, is that China is a net exporter. So a devaluation of the currency would actually bring in Forex income. But we, as Indians, are net importers right from our independence. So when we devalue our currency, all the landed price of goods and services that we import go up, which means imported inflation. You're actually importing inflation when you're devaluing your currency as a net importer. And the biggest worry would be on fossil fuels. I call fossil fuels, which is natural gas and crude oil, as multiplier commodities. Why do I call them multipliers? Because you increase the price of oil and gas at the petrol pump, and suddenly the very next day you'll find your milk, vegetable, eggs, meats, pulses, grains, etc. all going up. So it has a multiplier impact. So if we were to devalue our currency, and if you read the media reports about the SBI, the State Bank of India's research report about where they expect the Indian currency to be during Trump's tenure of 2024 to 2028, they are actually talking about 8 to 10% depreciation in the Indian rupee in Trump's tenure. That's not exactly very great news. Now, inflation will go up because of that, and you need not be a registered taxpayer, because inflation, as per the Austrian School of Economics, is a taxation by another name. So whether you're a taxpayer or not, you will be paying extra money just because inflation went up and your household saving comes down during inflationary times. So Trump's tenure is likely to be inflationary for emerging market trade partners of the United States. Now, let's take a look at the different asset classes. Foreign exchange. How will the Indian currency peg fare in the Forex markets? Now, Trump is likely to be challenging for emerging markets. Now, why is his tenure be challenging, including for India? Because the dollar happens to, on a long period average, LPA basis, tends to appreciate versus the Indian rupee between 3.5% to 5% per year since independence, since a little more than 7.5 decades. Now, there are years when the rupee does not depreciate against the dollar. But then what we have seen as per historical long period average experience, the rupee then makes up for it in the following years, and then the long period average is restored to 3.5% to 5% per annum. Now, actually speaking, if the long period average is 3.5% to 5% per annum, and Trump is going to be president for 4 years, which means it could be anything between 14 to 20%. So SBI's report is not something that you should be alarmed about. Hey, that's going along routine lines, but inflationary nevertheless. Now, what can you do about the currency peg? Unfortunately for us retail traders, the Reserve Bank of India and the Securities and Exchange Board of India have not allowed us retail traders to take any more bets on the exchange traded platform in the currency market. This notification has come recently in the sense couple of quarters ago, And therefore, you and me can't hedge ourselves by basically going long on the USD INR, where the United States dollar is the base currency and the Indian rupee is the quote currency. But what you can do to mitigate this risk to a very large extent is buy bullion. And that is covered in these two videos. The first video is about why I expect bullion to go up, and the second video is how to buy bullion in the purest form at honest to God prices in the Zaveri Bazaar or the jewelers market in your city. Now friends, I come to the commodity markets. Now the Trump reflationary rally expected in 2017, when he actually assumed office in the White House, is something that legends are made of. A real world trading participant will tell you that this was an extremely heady time. Hopes were very high that Trump would work magic on the economy, which is why the most sensitive commodity where the economy is concerned is copper, because it's used across the board in the most number of industrial segments. That's why it's called Dr. Copper, or the tin roof of the economy. So Dr. Copper, which is the bellwether of the economy, gained in 2017. It gave way to reality biting in and fell in 2018. So if at all you're hoping for a Trump reflationary rally, hold your horses. It's not half as easy as you think it is, and past experience need not be repeated in lockstep in the present day and age. Copper remained under pressure till the lockdowns saw tremendous amount of currency, unbacked currency being printed by central bankers in many parts of the world, starting with the United States, gave a boost to all asset classes and things went to the moon and back. Now, aluminium also went up, but it was more because Trump imposed sanctions on Rusal, Russian aluminium, as a manufacturer. Because Trump had warned Rusal against dumping aluminium in the global markets, and when things didn't really go as per Trump's blueprint, he imposed sanctions on them, and the markets went through the roof. Aluminium hit circuit after circuit. If you've been connected with me long enough, and if you've read my articles on money control, I have written about this aluminium trade, and I told you I did not really support the price of aluminium as sustainably high, which is exactly what I think is happening in the present situation as well. I think copper and aluminium are not in a super cycle. I've said that many times in my social media posts, videos, live mint and money control columns, that I do not subscribe to the super cycle theory. Now here again, why Trump's tenure will not be a super cycle for industrial metals: because of Latin America, LATAM. 40% of all global copper is produced by Chile and Peru. Now, if you were to see Brazil, Argentina, Ecuador, Bolivia, and other nations, many of commodities, both farm as well as non-farm commodities, are exported by Latin America. And almost all these countries are up to here in overseas Forex debt. If at all they are going to be able to service their debt and repay it, they will have to export whatever natural resources that they get out of the ground. This is something that nobody seems to be discounting as much as they should be, which is why you and me as real world traders have to see very clearly. Leave aside the non-trading experts. Look at the ground level. Where is copper? It's down more than 20% from its peak, and therefore, as per the Dow theory, it is in a bear market. If you've gone long on copper, how much would you have paid in mark-to-market losses, cost of carry, which is nothing but financing cost, and then how much down would you be? By back of the envelope calculation, more than 250,000 Indian rupees per single lot of copper traded on the multi-commodity exchange in India. So forget about the reflationary rally. Sure, there will be short-term spikes. Sure, there will be very vicious moves in copper and aluminium, because zinc, lead and nickel, of course, is out. Zinc and lead are not very frequently traded, and the volumes are very, very poor to be able to justify fresh trades. But those short-term spikes will be more of enticers rather than sustained upthrusts. Now let me come to crude oil and natural gas. I have been debunking the super cycle theory in crude oil and natural gas since 2021. I've been telling you I don't buy this theory at all. Now, oil and gas, even in 2017 and 18, went about their trading patterns as per their historical cyclical patterns. Gas goes up during winter, comes down in the following summer, and that's precisely what happened. One important geopolitical event occurred in October, which is exactly 2nd October 2018. Jamal Khashoggi, the Saudi-based journalist writing for American publications, was murdered in Turkey, and after that crude oil went up. And there was also the issue about Aramco's IPO, which was planned for many, many years, but finally it took place only in the end of 2019. So oil had a little bit of an upthrust, but that same logic does not exist in 2024-2025. So theta decay in the non-linear options, where the premium on the long calls and premium on the puts are not really equal, which is why there is something called a skew in premium. So theta decay in skewed options, out of money options, is the way to go forward for both oil and gas. But do consult a certified registered investment and trading consultant before taking any trades. This is a very, very risky trade. Oil and gas are known to be widow makers in the commodity markets. What do I think about the procyclical hysteresis theory that I have talked about in these two videos? Hey, my hypothesis on procyclical hysteresis remains in place. Whether it's Trump or no Trump, whether it's Kamala Harris or anyone else, I don't really think there is any data suggesting that we should be rethinking the procyclical hysteresis hypothesis. Sure enough, expectation of Trump's do good or feel good factor to the US markets might just prolong the onset of procyclicality. But if you ask me, the commodity markets are already indicating that procyclicality has come knocking on our doors. Admittedly, I was expecting this in 2025, but it's come at the fag end of 2024 itself. Undeniably, I think procyclicality is not something that you can avoid. And as I wrote to you in great detail on my Telegram channel, that a phalanx formation in the charts in the Indian equity markets has also been identified, spotted. Now, for some geopolitics. Now, Trump won't send boots on the ground, which is US soldiers on foreign soil to fight foreign wars. Trump has very clearly said, no more wars in my tenure. I find no reason to doubt that. Do remember, Trump has no combat experience. He has never worn a uniform in any draft. As a matter of fact, he was to be drafted 5 times, but he evaded the draft and therefore has no combat experience. Nothing wrong with that, all right? He's a businessman, he's a capitalist, and he's a billionaire. So he'll focus on trade and commerce more than war. Understood. So it's not really surprising to me that he will not send American boots on the ground on foreign soil. But do you think the military industrial complex of America, which is the weapons manufacturers, are going to idle their plants and sit quietly and go for vacations? I don't think so. So unmanned aerial vehicles, drones, bombing raids by the US Air Force, missile attacks, supplying weapons to US allies, etc. It will go on and it will be business as usual. It's just that manpower will not be on foreign soil. You will not have US soldiers coming back in body bags from overseas wars. But remain assured, a great degree of revenue that the US government realizes is from weapon sales, and that is likely to continue. So not much of a change as far as the US military industrial complex is concerned. Now, what is Trump going to do about the ongoing war between Israel and Hamas and Israel and Iran? Now, let me take you back in time to 6th December 2017. Now, the US government made a proclamation on this date recognizing Jerusalem to be a part of Israel. And not only did they recognize Jerusalem as a part of Israel, but they shifted the US embassy from Tel Aviv to Jerusalem, thereby saying, look, we are not just recognizing it, but we are also participating in the shifting of our US embassy there. And therefore, this is where we are going to stay put. So as far as his tilt or his loyalties are concerned, he's already said he is going to side up with Israel rather than with Iran. Now, what about Iran? Are sanctions on Iranian oil and gas exports going to work? In my opinion, no. If you've been with me long enough and you've read enough number of articles that I've written for LiveMint, for Money Control, I've spoken on YouTube channels of variety of media houses, I have said in the last 3 to 4 years, especially after the Ukraine war started in February of 2022, there is a whole lot of shadow inventory that does not exist in the books of accounts, being transported by ghost ships that are officially been scrapped, but miraculously they are still plying in the international water without GPS transponders, without country flags, without any serial numbers and markings, whose threadbare crews do not carry identification or passports. They are not insured, so there is no documentary evidence that they are there. They deliver crude in the high seas where no nation's jurisdiction applies. And since the delivery is made during the night, identification via satellite becomes a little challenging. So Iran has basically done a lot of oil trade in the unofficial or the parallel market, as you want to call it, in unmarked tankers. The Russians are doing it, the Venezuelans are doing it. So what will happen to Iran, Venezuela and Russia is, sure enough, the sanctions might continue. All that these guys will have to do is just mark down the price of crude by 5 to 10%, offer a little bit of discount, and there are ready buyers in the ghost market for unofficially existing crude and natural gas inventory. So it will continue. I don't think Iran will come down on its knees tomorrow morning after Trump occupies the White House tonight, hypothetically, although it's going to happen in Jan. Friends, let's now come to the fixed income market. The bond market's very close to my heart. I've been telling you this asset class is what determines the price of the other asset classes. Now, I have been pleading with my online family, please understand the cost of funds concept if you want to succeed in any asset class market. So you might be a commodity, currencies, bond or equities trader, but unless you know how interest rates, bond prices, bond convexity impacts the prices of all other asset classes, you are going to suffer a handicap. You will lose money to a guy who has ideas about cost of funds. Please do read Dick Stoken's books on cost of funds. They are an absolute gold standard. They may not be easily available because most of them are printed in the 1990s. But go to Amazon Marketplace, Alibris and Abe Books, etc., which are selling pre-owned or second-hand books, and you're definitely going to get them at a very low enough cost. So real effective interest rates will go up, or if not go up, remain constant during Trump's tenure. I have been not agreeing with the expert opinions that interest rates will go down. Fair enough, headline interest rates might just go down. It's called the prime lending rate. So banks all over the world might tell you, okay, we are making a cosmetic announcement that interest rates are coming down. But the true test of the interest rate is, can you actually borrow at that rate? The prime lending rate is available only to the prime or AAA plus borrowers. A rank and file borrower does not fall into the prime lending category. He is bound, or he is a subject rather, to MCLR rates, which are more closer to the cost of funds of the banks, and banks' cost of funds are going up. Why? Why am I saying that? Look around you. Google search HDFC Bank, the largest private sector bank, SBI, the largest bank in India, period, public or private. How big is SBI? Two-thirds of all banking in India is done by SBI. It's that big. Two-thirds of all banking, private, foreign and public sector, is SBI. And SBI is offering you higher coupons. Bank of Baroda is offering you higher coupons. Canara Bank offering you higher coupons. So MCLR, cost of funds, is actually high. Headline interest rates might come down, but you will not get to borrow at those rates. What will happen is that maybe depositors might get lower interest rates on their FDs. That too, I'm not really sure. But I do not think that the bond market will basically witness a huge turmoil in President Trump's tenure. Why? You see, governments the world over have printed a huge amount of unbacked currency. Case in point, 1 out of 4 or 5 US dollars in circulation in the global economy have been printed after 31st March 2020, when the global economies went into a lockdown. That's the kind of money, unbacked currency that the US has printed. So have other countries. They can't really go out there and print unbacked currency at the rate at which they were doing so earlier. You're going to see an inflation hyperstorm, not a storm, hyperstorm. So printing currency is out. What do? You borrow money from the bond market. Sure, the government would want lower interest rates so that their borrowing costs would come down. But you know what? It's still the check writer's money. And this is something that you have not been taught very well. You have been taught to think that lower interest rates boost the economy. To a degree, it might be true. But it boosts the economy because the borrower can borrow cheap. Have you asked the check writer, the depositor, whether he is happy with lower rates? Hey, no, I'm not happy writing checks at lower interest rates. Check writers are now asking and getting higher coupon rates because they are not writing checks unless they are given higher rates. Because inflation is up, therefore real effective interest rates or post-inflation adjusted rate is going to go up higher. So if you're looking at buying gilt funds, I think you should keep the powder dry. Let's wait for a while. We've already exited gilt funds in middle of March 2024. I think our time will come at a later date. Prior to that, if my calculation is right, we might just have to buy, or we might be able to, not have to. Have to phase is done. We've laddered all the way up to 7.5% yield on Indian 10-year benchmark sovereign yields, as I have been telling you since 2021. So we might be able to buy bonds before we are able to get gilt funds. That's of course a hypothesis. The market will tell us whether gilt fund investments will come first or the 10-year sovereign will come first. But it will come. Friends, I now come to equities, and I'm sure you're waiting for this. I think 2024, when Trump assumes office and shifts into the White House finally, will see the biggest change that you have seen in your life. And I'm talking of traders like me who've seen the markets a lot. I came to this market in 1986, so I've been around for 38 years. Now, the biggest change that will happen in 2025 is that our markets will see a huge influx of high-frequency traders, algo-based traders, artificial intelligence-based, big-ticketed, big-pocketed traders coming in from Western countries and setting up shop in India. Jane Street was not an isolated incident, and I'm sure you would have Google searched and seen the results. There are more Jane Streets waiting and setting up shop in India. What do these guys do? They do high-pressure trading, which trade turnaround time of minutes to hours. Now with these guys, you and me as local retail traders will have to compete. It's not going to be easy. And I've been telling you 2025 onwards is the time of a smart, intelligent statistical systems traders. Either you ramp up your skill sets or you will basically see your trading take home profits fall fairly sharply. And no, I'm not spooking you or scaring you because I offer any kind of paid services at all. Me, my companies, any entities that I am a founder, promoter, or a director on the board do not offer any paid services. If at all you are approached by somebody, today somebody created a fake Facebook profile of mine with a picture from my wall itself and demanded money from people. If at all you are approached by any such entity, report this matter to the cybercrime people without fear of favor. It's not me. I don't charge money at all. I take my money from the market because I'm a trader first, foremost, and always. So you're going to have very, very challenging times ahead by competing with the finest, the best of the best high frequency traders who will start coming into India from 2025 onwards. And you will require a bigger amount of capital because SEBI will ramp up the F&O lot sizes. So your span margins, your mark-to-market margins, and your exposure margins, which kick in after 60% of MWPL is reached, will mean that you sink in more and more money into your capital account before you can trade, and your return will be crimped because there will be faster and more stronger, bigger pocketed traders than you snatching the trade right in front of your eyes. So capital involvement higher, profits slightly lower. You'll have to get used to it. You'll have to adjust your sales because the winds are changing. Frankly, and before I proceed, this is not a critique. Everybody has a right to think what they want to think because it's still a democracy. Now, I see a lot of exuberant optimism in the markets. It's interesting to see how they think. And what I see is a huge amount of reckless bravery. And this comes especially from non-participating guys with little or no skin involved in the game, which is also fair because for every trader, there must be somebody who's an advisor who's sending the retail guy out to the battlefront and saying, look, this is what you should be doing. We think you should be buying. You think you should be selling. Now, if at all you have contrary opinions, do remember these are electronic markets. For every buyer, there has to be a seller. Otherwise, trades don't take place. This is called counterparty risk. We welcome, as you and me are doers of deeds, real world traders, we welcome contrary opinions because we need counterparties to trade with. When we want to go long, we want somebody to sell stock to us. When we want to go short, we want somebody to buy the stock we want to short. So far, I think a whole lot of people are assuming that the cakewalk that they've had between 2020 to 2023 is likely to continue. Banish that thought. Let me give you some statistical data. You might want to brush it off, and that's completely all right with me. But the kind of declines that you have seen in the recent past, let's start from 4th of June, which was the election result day. I saw stocks in public sector units fall 15, 20, and one particular counter, BHEL, going 25% down in a day. Although there was a clawback and recovery very shortly, but how many of retail traders would have survived that and not got exited out of the sheer margin calls? The next one was 23rd July, the day of the union budget. The next phase was between 1st and 5th of August 2022, another noticeable fall. 5th and 6th of September, another steep minor fall. Now, the big period between 27th of September to 7th October, sizable fall. Then there was a sideways movement, a slight corrective advance, and then what we have is a bone-crunching decline between 15th October to 14th November as I record this video. It's all right for somebody who's sitting in the stands as a spectator and saying, look, every time the market went down, on 4th of June, it fell down, these stocks fell 10, 15, 20, 25%, but they came up, didn't they? Hey, sit in a trade and talk. When you see stocks falling like this frequently, and in the month of September and October, twice every month. Otherwise, from June, every single month, June, July, August, September, October, you've seen bone crunching falls. Sure enough, there have been pullbacks till September. After September, there's been no pullback at all. The guy who's footing the mark-to-market margins is getting replaced and chucked out by margin calls, and another guy who has missed out on the rally earlier is listening to all that bullish talk and coming in and buying, which is why the MWPL or market-wide position limits are still rising just as they were before Trump was in power or Trump came to power. But notice something, as I told you in my last weekly market outlook video. MWPL fell after the expiry of October series to a lowest in 5 months, and now post expiry the rally is also at the slowest pace. There is some amount of nervousness showing. Now it's up to you. You could very well, justifiably so, and I have no contest with you here, say I'm going to go like business as usual. I'm going to go out there and buy because I am a bull. Or you could go out there and say, listen, I'm going to be a little more cautious because I don't see the numerical data supporting outright bullishness, and therefore you could take a different path. Completely all right. Now, keeping your head in the sand and ignoring data is not something that I would advise. I am a database guy, I'm a statistical trader, and I feel that paying cost of carry, which is rollover cost for traders, and I speak as a trader, not as an investor. Cost of carry is going to eat you up, and our elders used to say that people who live under debt don't get rich. The cost of carry will go up. Mark my words. When bears push the markets down, they will demand a bigger cost of carry from the bulls so as to roll over their trade from 1 month to the next. So your cost of carry will add on to your acquisition cost. Your mark-to-market payouts will make you weaker, and your execution costs will keep adding up and increase your acquisition cost. You have to be completely prepared to foot all these. If you're deep-pocketed, maybe you could also make money. But are you willing to do that? That is the point. In my options videos that I recorded a couple of months ago, I explained to you why the concept of paying interest is a losing proposition, which is why option buyers, month after month, rolling over their long positions by buying calls, invariably tend to surrender money to option traders who use certain criteria like writing options in deeply out of money options, which I explained to you in that video, where MWPL is more than 60-65%, so there is a risk or a threat perception of a crowded exit, and the standard deviation is at least 50% higher than the aggregate of the entire F&O list. And the entire F&O list reminds me that we are going to have 45 new counters to trade from end of November onwards. A little bit of work you and me will have to do as statistical model traders, because we'll have to incorporate 45 new stocks, 45 charts, oscillators in each charts, the churn ratios, the ticket size per trade, and MWPL, etc. But hey, we've done this in the past on smaller number of additions and subtractions. This time around, it's a big 45 additions. So like I said, 45 new opportunities to earn theta decay from non-linear or skewed or biased options premiums from 45 new counters. Let's keep our fingers crossed out here. Now do remember, we traders are brain warriors. We fight with our ideas. We are not supposed to lift heavier weights, run faster, swim faster or longer than our opponents. We are supposed to sit quietly in a chair, press the right buttons at the right price and at the right counter, and beat the other guy, take his money out of his pocket and put it in our pocket. So think smart, think sharp, and be quick. Let's stay ahead of the crowds, which is what I always tell you. Now, I remind you again at the cost of repetition, please do understand the cost of funds as explained by Dick Stoken in his books, and the name of the author is in the pinned comment below this video. Now, as is my habit, I do not give individual trades, neither in my media columns nor in my videos or social media posts. But I could share certain sectors which I will focus on. Now, my theta decay strategy will be on interest rate sensitives. I've already shared the reason why: cost of funds. Dick's token has explained it like nobody else in the world can. Public sector banks, oil marketing companies have been my favorite. I've been writing about these in my live mint column since a minimum of 2 to 3 quarters. And look at the way they've been slipping. Energy, power, defense, logistics, and to a small degree, metal miners. Do remember, I do not subscribe to the super cycle theory in industrial commodities. So, industrial metals included. Bullion, bullish. Give me big enough declines and I would say go out there and buy. I've explained to you in this video as to why you should be welcoming declines in bullion. So will there be no respite at all? Will there be a one-sided fall? Hey, I'm not saying that at all. There will be intermittent rallies. They will be sharp. They might even fool you that a bull market is coming. But I don't think sustainability is something that I want to avoid looking at, and therefore I will be constantly looking out for the ticket size per trade, for the MWPL, as also the churn ratio. I've explained to you in this video on MWPL. This is not the kind of data that you're going to get anywhere else, but from a real world trader. It is of a real world, by a real world trader, for a real world trader. I hope this strategy of mine is going to see you through the calendar 2025. We'll take a relook at the end of calendar 2025 for 2026. But that is a story for another day. Before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know what more you would want me to record to help you become a better trader. And hey, please do share my videos with like-minded traders like yourselves so I can reach out to a wider audience and spread the cult of knowledge-based trading. I wish you all the best. Take care. Bye-bye.